2008, the pursuit of immediate profit eclipsed basic financial oversight. Banks generated massive returns, but those top-line numbers masked severe, systemic decay. Lenders built immense portfolios of mortgages, issuing them to borrowers who simply could not afford the repayments. These loans were packaged and sold, completely detaching the complex financial transactions from the actual human beings holding the debt. As those defaults rapidly piled up, a glaring question emerged. Trillions of dollars were in motion, yet there was a total absence of stewardship over these assets. Who was actually tracking the risk? When organizations optimize exclusively for immediate strategic gains and abandon their responsibility to track where the money actually comes from, entire economies face devastating collapse. To prevent that kind of disaster, businesses rely on a rigid control mechanism. While often mistaken for pure mathematics, accounting actually operates as the foundational information system of a business. This system functions as a three-part pipeline. First, it measures raw, chaotic business activity. Then, it processes that data into legible reports. Finally, it communicates those results to the people making the decisions. Without this definitive pipeline, translating 1 million disparate economic actions into an organized, readable reality is impossible. To organize that chaos, every economic input relies on a universal classification method, the acronym ALICE. The first two categories define the company's state. A is for assets, the resources it owns. AL stands for liabilities, its debts. The next two track the incoming wealth. I represents income, the money earned from daily operations, while capital is for capital, the baseline wealth invested by the owners. Finally, E stands for expenses, detailing the wealth spent to keep the operations running. Whether we are looking at a local coffee shop or a multinational corporation, every transaction must fit perfectly into one of these 5 buckets to keep the financial narrative intact. Once that data is categorized, a structural tension emerges. The information must serve 2 distinct, conflicting mandates at the exact same time. The first mandate is stewardship. This is a backward-looking function that provides historical accountability, proving to owners that their resources were not mismanaged. The second mandate is decision usefulness. This is a forward-looking function that helps users allocate resources and make informed strategic choices for the future. Trying to fulfill both a strict historical audit and an agile future strategy forces the entire discipline to split into 2 separate branches: financial accounting and managerial accounting. This diagram shows primary users of business information. Financial accounting serves external groups on the perimeter, like lenders and government. It's a rigid historical system bound by generally accepted accounting principles, ensuring watchdogs see an accurate reflection of the past. Managerial accounting, however, serves internal leaders in the center. It carries no strict regulatory restrictions. It is highly detailed and future-oriented, giving managers the exact data needed to steer the organization. The external financial view protects the public and investors from deception. Meanwhile, the internal managerial view provides the only tool preventing the company's leadership from flying blind. Returning to the 2008 crisis, even the most sophisticated reporting pipeline fails if the underlying data itself is flawed. This flowchart maps out the qualitative characteristics of accounting information. The crash of 2008 occurred because the financial products driving the market failed these exact tests. The loan packages became so dense and detached from the actual borrowers that they lost their verifiability and their faithful representation. When data is manipulated to strip away these required truths, accounting stops functioning as a protective information system. Instead, it becomes an instrument of systemic risk, accelerating the damage. Whether managing a single-person proprietorship or a global limited company, the practical purpose of accounting remains identical. It acts as the primary control mechanism for strategic management. The system compares planned budgets with actual outcomes. Managers identify the variances, the gaps between what was planned and what happened, so they can take immediate corrective steps, forcing operations back on track. Accounting exists as a balancing force, harnessing the human drive for corporate profit while enforcing the undeniable reality of stewardship.